Hello once again. The recent decline in FANG stocks, also known as Facebook, Amazon, Apple, Nvidia, and Google, have spooked the investing public, causing the S&P 500 index to briefly hit 7,000 points and subsequently decline all the way back down to 6,900 points as of yesterday's close. Some of you might be thinking that now would be a good opportunity to buy into these mega tech companies at a cheaper price and ride the upside of the AI boom. But is this true? Today in this video, I will share with you the reasons why FANG stocks have declined in the past month and whether there are any buying opportunities right now. Watch till the end of this video to find out. Hello everyone, welcome back to SDA Club, the club for stock trading and analysis. This channel is dedicated to providing you with high quality tutorials, guides and insights that demystify the world of trading. Join us as we will share more trading secrets and valuable insights. To stay updated and to be the first to access these valuable resources, hit the subscribe button now. By subscribing, you're opening the door to a world of trading and maximizing your potential for success. Before we dive in, here's a quick disclaimer. The information in this video is for educational purposes only. It's not a call to buy or sell. The decline in FANG stocks during February 2026 was driven by a shift in market sentiment from AI optimism to AI scrutiny. After a massive run-up, investors began questioning the timeline for returns on the billions being spent on artificial intelligence infrastructure. Here are the three primary reasons for the downturn. Number 1. The CapEx shock. A major trigger for the sell-off was the release of their 2026 capital expenditure, or CapEx, guidance for most of these FANG companies. Investors grew concerned that these massive investments in data centers and chips would weigh down free cash flow without providing an immediate proportional boost to revenue. Number 2, the Anthropic shock and disruption fears. In early February, Anthropic, a major AI competitor, released new automation tools capable of handling complex knowledge-based tasks like legal reviews and financial analysis. This sparked a disruption panic. Instead of seeing AI as a tool that helps big tech, the market began to fear that AI-native startups could disrupt the established business models of the FANG giants themselves. Software and services were hit hardest as investors revalued which companies have defensible moats in an AI-first world. And number 3, hawkish macro and political shifts. New tariffs on imported goods announced by President Donald Trump have come into effect, days after the country's Supreme Court struck down most of his previous tariff regime. These additional tariffs further spooked the markets. Even though macroeconomic data in the US remains strong, stronger than expected payroll reports led the Federal Reserve to signal that interest rate cuts would be delayed. Rising treasury yields have also hurt high-growth tech valuations because future earnings are discounted at a higher rate. By mid-February, the Warren Buffett indicator, which is the total market cap to GDP, reached an alarming 220%, higher than the 2021 peak. Many institutional investors viewed the FANG stocks as priced to perfection, leading to a natural correction as traders took profits to rotate into more defensive sectors like financials or energy. Let us now look at the reasons behind each mega tech stock decline. Let's begin with Meta. In the past month, Meta declined 3% because of a massive shift in how the company plans to spend its cash. Meta announced it would spend between $115 to $135 billion in 2026, primarily on AI infrastructure. These include data centers and Nvidia chips. This was a massive jump from the $72 billion spent in 2025. Investors were horrified by the scale of the spending, fearing it would dry up free cash flow and hurt the company's ability to continue stock buybacks. Alphabet, or Google, on the other hand, declined 6% in the past month as CEO Sundar Pichai announced a capital expenditure forecast of $175 to $185 billion for 2026. This is nearly double the $91 billion spent in 2025. Investors grew concerned that this massive spending on data centers, energy infrastructure, and custom AI chips would cannibalize the company's free cash flow. Some analysts projected that free cash flow could plummet by over 90% in the short term to cover these costs. There is also a growing anxiety that while Google is spending hundreds of billions to build the pipes for AI, the actual revenue from AI-specific services is growing at a slower, more linear pace. Amazon's stock price decline of 12% in the past month was due to CEO Andy Jassy announcing plans to spend a capital expenditure of $200 billion in 2026, a 60% increase from 2025's $125 billion, elevating fears of eating into its free cash flows. Microsoft's 15% decline in the past month was due to a potential concentration risk panic on its single future revenue generator, OpenAI. If OpenAI struggles to monetize its AI models or burns through its cash faster than expected, a massive chunk of Microsoft's future cloud growth is at risk. Microsoft reported a quarterly capital expenditure of $37.5 billion, which was a 66% increase year over year. Much of this spending was on short-lived assets like GPUs and CPUs that need frequent replacement. Wall Street began to worry that the $120 billion annual investment would erode profit margins before the revenue from AI agents could fully materialize. Analysts downgraded Microsoft's stock to hold in early February, noting that the enterprise adoption curve was slower than the spending curve. While the broader FANG sector faced a general AI scrutiny sell-off in February 2026, Apple, on the other hand, had its own specific set of headaches. Apple's concerns were primarily driven by execution fears due to the AI race and rising material costs. Analysts have reported that Apple's in-app voice commands for Siri were lagging and led to concerns that Apple was falling further behind the AI race. Analysts were also concerned that the rising prices in memory chips would cause a squeeze in Apple's hardware margins toward the second half of 2026. Of all of the FANG stocks, Apple was however somehow spared from the full brunt of the punishment and was up 7% in the past month. So, which of these FANG stocks have the best buying potential now? Of all of the FANG stocks, I think Microsoft could present a buying opportunity. Microsoft's core business in enterprise software could continue to dominate market share. Microsoft is currently the world's top 3 vendor in enterprise application software and holds roughly a 7.45% share in application suites like Office 365, with 85% of Fortune 500 companies currently using its services. Therefore, switching to another competitor might be very difficult, and most companies would not expose themselves to business continuity risks until a better alternative shows up. With Microsoft's price-to-earnings ratio now below its historical 10-year average of 30 times, this presents a good buying opportunity. Why? As you can see here in this chart, Microsoft's earnings per share has consistently climbed since 2012 and is currently the highest as of 2026. However, its stock price has since corrected due to fears of intensified competition in the AI space. Are these fears warranted? Based on Microsoft's current strong business fundamentals, I believe its long-term growth potential is still solid, as Microsoft still has a strong moat on its core businesses. For more information on how you can optimize your portfolio and would like to seek advice on your current investment portfolio, speak to us by replying to the WhatsApp link in the comment section below, and our team can provide a personal touch and talk to you about your investment plans. See you in my next video. Goodbye.